Hello friends, this is Vijay Bhambwani and I'm back with you to talk about the weekly market outlook in my video. Friends, last week I basically recommended that the markets were likely to climb over a wall of worry, and statistically speaking, the Indian markets, as per the data from in-house statistical model, the IBEX, was pointing out that the buyers were likely to outnumber the bulls. This is something that I even wrote in my weekly column in the live Mint, the Mint newspaper, that the Indian markets had a better chance of going higher rather than lower. It was a very aggressive, bold call, and since the data suggested it, we went for it, and it worked out beautifully well. So let's see what this data is pointing towards for the coming week, and let's take a deep dive into what our systems are saying. So the weekly market roundup window is basically showing you that the Nifty outperformed the Bank Nifty. Bullion rose due to inflationary fears, due to rising oil and gas prices. I have been talking about the correlation between these various asset classes in the past few months videos, using our 360-degree world view, which I have been feeling vindicated by the market actions. The US dollar continued to rise, which is another concern because the landed price of imported goods becomes even more expensive, and two-thirds of all Indian imports are fossil fuels, which themselves are multiplier commodities, which I call them, because rising fuel prices trigger higher prices in foods, vegetables, meats, eggs, pulses, etc. The 10-year benchmark bond yield breached the 6.30 mark and settled there. And as you can see, the market-wide position limits, this measures the average limits utilized in the F&O space by traders, jumped to 30.07%, which is a routine event up to the third week of any derivative series. Now, what I want to seriously watch out for is whether this MWPL goes up to the 34-35% or maybe even higher. If it does, it would basically tell me that trader interest in the market is hitting new highs. That would tell me that the grip of the bulls might just become tighter, and it will determine what kind of a Diwali you and me as traders are likely to see in the markets as far as our financial investments are concerned. Now, let's take a look at the basis chart, which shows the futures premium over spot. Now, take a look at the Bank Nifty and the Nifty basis. They both rose mildly higher as compared to the previous weekend. This reflects a slight pickup in sentiments on a week-on-week basis. Now, let's take a look at the volumes chart, which shows turnover in the October, November, and December cumulative series. Indices, both Nifty and Bank Nifty in the index turnover, and all futures of individual stocks are in the stocks futures itself. Now, the turnover figures are fairly subdued, which tells me that there was skepticism by traders at higher levels because most were not expecting an up move and they got left out of the momentum bars. Now, will there be FOMO? FOMO is fear of missing out. Will there be FOMO next week? Will there be FOMO triggered buying next week? If yes, that means the market will go up higher because people who are feeling left out will now come to buy. That would be something that I will watch out for and update on my social media accounts, where you can connect with me every day. We can get conversations going and help each other become better traders. Now let's check out the Impetus Chart, which by and far is one of the most reliable indicators we have presented so far from our in-house statistical model in the public domain. The impetus has fallen rather noticeably on both the indices, which for me is a mild concern. Ideally, I wanted the prices to rise accompanied by rising impetus. So we'll have to put this study on very active watch all of the coming week. Now, a slowing market can always pick up. That is something that can always happen. We need to monitor that fact. And right now, the bulls seem a little skeptical, which I mentioned earlier. So it's not exactly something that you need to lose sleep over at night, but do note that the impetus was lower. Friends, let's now take a look at the footprint of various market participant types. The FIIs have basically reduced their index net long index futures to 22,480 lots, which was last week 26,831 lots. Their stock futures longs have also come down marginally to 1,16,954 lots, which last week was 1,25,236 lots. The domestic investment institutions, the DIIs, their index shorts have basically reduced marginally to 77,721 lot short, which last week was a short position of 77,977 lots. Their stock futures shorts have come down marginally to 12,94,459 lots, which last week was 13,151 lot net short. Where the proprietary traders are concerned, now these are brokers' own prop trades, and they are the next best thing to insiders because they know who's buying and how much. So the prop traders have increased their index futures short positions to 18,456 lots, which last week was 9,160 lots short. Where their individual stock futures are concerned, they've increased their net long positions in individual stock futures to 2,05,845 lots, which last week was 1,89,380 lots. What's the retail segment doing? Now, this segment has been a fairly good barometer of which way the markets are headed, and the retail guys have increased their index net long positions to 73,697 lots, which last week was 60,306 lots. Their stock futures positions are marginally lower at 9,71,660 lots long, as against last week's 9,85,535 lots long. The noticeable thing about the retail guys is that they are definitely not increasing their long exposure, and they have, like I said, been fairly good barometers of which way the market trends are headed. Now, friends, let's take a look at what's likely to enthuse the market, what's likely to worry the market. SIPs, or systematic investment plan inflows in mutual funds, have crossed 10,000 crores in a month for the first time, which means the retail segment continues to pour money into the market, and as long as this money keeps coming, the market is likely to stay firm. The RBI announced its interest rate policies, and they kept interest rates constant, unchanged, and the outlook was very accommodative from the RBI. They're going to continue supporting businesses by keeping the easy money policy on, and therefore the markets are likely to cheer this situation. The third aspect is that the Chinese credit crisis is witnessing a lot of money leaving China, where the bond markets are concerned, and coming to the Indian bond markets. Now, this is something which nobody told you last week, and in our video, I laid out 3 points. The UAE India Comprehensive Economic Partnership Agreement Indian bonds getting listed in the overseas indices, and local NRI and local Indian investors being directly allowed access to the RBI bond platform. Now, here is the third point, that the bond market in India is a direct beneficiary of the challenges in China. So that's likely to keep the markets firm. The disinvestment of Air India in favor of Tata's is sending a positive signal to the markets, and further disinvestments of fresh PSUs may not be ruled out. Vaccination is proceeding at a very rapid pace, and COVID cases have come down. And the sixth point, which I feel is likely to be fairly enthusiastic about the markets which are concerned about supply chain disruptions, container freight rates have started falling. Container rates themselves have started falling. So, international trade is likely to remain optimistic next week. Now, what's not hot? What's worrying the markets? Rising fuel prices are inflationary. That might be a back of the head kind of worry for the markets. The rising USD INR, which means the dollar strengthening against the rupee, might trigger imported inflation. Imported inflation is when whatever you import is more expensive, and therefore it leads to price rises. And bond yields have now hit 6.30%. Now, that means the interest rate cycle may be bottoming out, and I'm going to speak about it in a greater detail in the bond segment. So let's jump right on to the bond segment. The fact that the bond yields have spiked to 6.30%, which is almost the upper end of the half-yearly's trading range, it means that the bond markets are expecting interest rates to be near a bottom, and the cycle may turn upward soon. The RBI governor more or less shut the GSAP, the Government Securities Acquisition Program. He almost shut the GSAP window completely, saying that the RBI will not buy back bonds from the banks, and only if there is a dire need will they come back to offer more GSAPs. OD limits have been kept accommodative, and the monetary policy remains focused on growth rather than focusing on inflation, which I think the RBI expects, which is inflation, to remain subdued, which is again likely to cheer the markets in the coming week. Friends, let's now take a look at the Dixie, the US dollar index, and this US currency benchmark rose on a week-on-week basis, rising on 2 out of 5 trading sessions last week. The price remains above the 93.5 level mark, as well as the 25-day exponential moving average, which is the approximate cost of an average bull having month-long buy positions. This means that the short-term trend remains positive for now. The weekly chart shows a long leg doji, wherein the open and close are next to each other, almost close to each other, with the high and low being distant from the median or the center. This indicates a draw between bulls and bears with a bias towards the upsides. A rising dollar can pressurize emerging markets, including India. So this is a minor red flag as far as I'm concerned. And the price remains above the 25-week exponential moving average. So the medium-term outlook also remains positive. Last week, I advocated a range between 95.10 on the upside and 93.10 on the downside, which held perfectly well. In the coming week, I expect this range to be maintained because the Dixie closed almost unchanged, and therefore 95.10 and 93.10 remains constant as far as the range is concerned. Friends, let's now jump to the Bank Nifty, which rose 1.48% on a week-on-week basis. And as you can see on the daily chart on your screen, it rose on 4 out of 5 trading sessions and stayed above its 25-day exponential moving average, which means the month-long buy positions average price is lower than the current market price, and the short-term outlook therefore remains positive for now. We need to overcome the recent high and take the Bank Nifty trading sustainably above the 38,500 mark to rope in the retail traders who are skeptical and are sitting on the fence. Do remember that the impetus of the indices was lower, which we saw earlier, and now the weekly chart shows the last bullish candle is contained within the prior week's bearish candle. This means that there was a pause in the fall, but we still need to overcome the all-time high, which is amply emphasized in this chart, so as to escalate the up move. Even on the weekly chart, the price remains above its 25-week exponential moving average, which means the medium-term outlook remains positive for now. In the week before last, this index was number 5 on the most volatile list, but fell very, very sharply to number 68 last week because individual stock volatility simply went through the roof and it spiked amazingly high. While the Bank Nifty's impetus, as I told you, fell sharply. Now, last week, I advocated a range between 38,650 and 35,800, which held perfectly well, even though, even because rather, the volatility fell. The coming week is likely to see an estimated, I stress upon the word estimated, range between 39,150 on the upside and 36,400 on the downside. Friends, I would suggest you trade light because of the higher volatility in the markets and keep all your long positions protected with strict stop losses. Friends, let's now go to the Nifty 50, the most liquid traded asset on the National Stock Exchange in the derivatives segment, which rose 2.07% on a week-on-week basis and rose on 4 out of 5 trading sessions last week, as you can see on your chart. This index also remained below its all-time high logged in the prior week, and the price remained above its 25-day exponential moving average, and therefore the short-term outlook also remains positive. The overall trend remains upwards, as you can see in the upward sloping channel on your chart. The weak impetus is showing up in the small bullish candles that you can see on your chart. Now switching on to the weekly chart, it shows the last bullish candle contained within the prior week's bearish candle, exactly like the Bank Nifty, which we saw earlier. The 18,000 round figure hurdle must be overcome on a sustained closing basis to get the retail segment back in the buying ring. Now the price is above its 25-week exponential moving average, which means even the medium-term trend is up. In the week before last, this index was number 19 on the most volatile list, but it fell very sharply to number 81 due to the faster rise in stock futures volatility. Now that ties in neatly with the falling impetus that we checked out earlier for the Nifty 50. Last week, I advocated a range between 17,975 on the upside and 17,075 on the downside, which held perfectly well. Note how last week's high was 17,942, a mere 33 points below the high that I advocated at 17,975 levels. Now, this is, like I explained to you last week, due to the telescopic beta factoring that we do in our statistical model, the IBEX. Now, the coming week is likely to see an estimated range. I stress upon the word estimated, range between 18,350 on the upside and 17,450 on the downside. Here again, my friends, I continue to advocate that you trade light in the markets because the overall volatility has been fairly high. Chances are any sudden news event may drive the prices exaggeratedly in any one direction, and your trade might just move against you without a warning. So do connect with me on social media, wherein I update these aspects every day at the end of the day in very simple parlance, which will help you trade the market more accurately. Friends, the indices done. I now come to the most popular segment of the market, wherein I give you 5 stocks which have seen a huge amount of beta compression, which means the volatility has come down, and 5 stocks where the beta has shot up significantly. And the high beta, high impetus segment where volatility has jumped up, where you will take small exposure and wait for bigger price moves. That stock list is led by Oberoi Realty at number 1, number 2 Bandhan Bank, number 3 Bosch, number 4 Page Industries, and number 5 Cipla. Now for low beta, low impetus stocks where volatility has fallen, and there you will take bigger exposure, wait for smaller price moves. The stock list is led by Apollo Hospitals at number 1, number 2 Star, number 3 Pfizer, number 4 Z, and number 5 Amar Raja Batteries. Now friends, this hierarchy of high and low beta stocks can change from day to day. As a matter of fact, even hour to hour. So I would request you to connect with me on social media. My contact coordinates will come at the fag end of this video, wherein I update a lot of stuff on my social media accounts, which can help you become better traders. Friends, I come to the end of this video, and I'd say goodbye to you, not before reminding you to click like on this video if you agree with what you saw, if it helped you understand the markets better. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. Comment section, I love to hear from my viewers as to what they think about these videos and how am I helping you to become, to stay ahead of the pack, ahead of everybody else. Just like I told you last week, the markets will rise when everybody else was bearish. Do refer my video to your family and friends and help me reach out to more and more people. Friends, in the description below the video, there is a hyperlink to my Equity Master playlist wherein I put up a couple of ideas every week. Do subscribe to that YouTube list as well. There is also a hyperlink to a free trading guide from Equity Master as a PDF file. Do avail of this fantastic free opportunity and trade better in the markets. Thank you for your patience. I wish you have a very, very profitable week ahead. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.